throw some light on this rising household debt? I mean, I haven't looked at the household debt to GDP data, but I think still it will be rising, even though we'll be below other emerging markets. It's 37% for us.
When we say consumption has gone up, pent-up demands, everybody has been consuming, I have not been saving. My incomes are not going up, jobs are not being created in adequate numbers. So today you look at it, most of the people in the organized sector, layoffs taking place. Startups have flopped almost across the board. So in this kind of a situation, the very fact that we see people going and taking more consumer loans, it's good for the banking system. I work in a bank, I'm very happy about it. You take loans against gold, it's a good sign people are borrowing money. But the fact that you're pledging gold means you're actually in a desperate situation. You don't want to give up consumption. Consumption levels have gone up because inflation has been very high. And I think one thing which people miss is when we say inflation is coming down, let's realize that prices are not coming down. 6% or 5% means I'm still paying 5% more. It's actually hardly a comfort. As economists, we can all say that number coming down, monetary policy targeting is inflation rates, so therefore we bring down rates. But the fact is, cumulatively in the last 3 years, inflation has gone up by 20%. Has your income gone up by 20%? The answer is no. So I think that's the problem which we are having.
Absolutely. So actually, it's not. The RBI data that I've seen, given household assets and liabilities, so household liabilities have not gone up. Household liabilities are the loans that the households take. Yes, there has been growth in credit to a very large extent has been driven by retail, and retail home loans, personal loans, etc. The gold loans, etc., are a very small component of the total the personal loans, the retail loans that banks give. So while there is an element of distress, of stress, if not distress, stress on household incomes and the desire to keep consumption levels high, so borrowing, but I do understand that some part of this is being used as an alternative means to finance, say, housing construction, retail, residential construction, loans against shares, personal loans, etc. Some part has been used till now to finance exposure to equity markets. So which is another reason why you are seeing that retail investments via mutual funds, via direct stock holdings has increased. Those are likely to come down because, I mean, equity markets will probably not go on all that much. But overall, household debt, the aggregate household liabilities and debt is relatively okay. In fact, which is the really remarkable thing that you have seen, that despite the very rapid 215 basis point increase in the RBI repo rate and actual market rates, short-term rates have gone up even more, much more than the increase in repo rates, there's hardly any sign of stress in either the retail portfolios or in the MSME portfolio, the micro and small. Of course, there will be some slippages which will inevitably happen. But the resilience of these segments seems to suggest that till now, cash flows have been relatively okay. So given all of this, the overall level of household debt, the amount of stress that we are seeing in the system, the potential of cash flows still being relatively okay. Yes, I mean, given the pace of interest rates hike, there will be some problem, but I hope that remains on the margin. The overall bulk of the bank and NBFC books, exposure to the micro, small and retail segments still remains relatively sound, which is actually what the RBI's financial stability report also suggests.